The new stuff, aside from like what I'm actually going to be going forward with. Today I'm going to be having a bit of a break day, a bit of a less foot on the gas, quote unquote, I mean it's also kind of good that it's that case because I'm at work today. But there's a couple new things that I've uncovered with research. Now I actually need to add some things. So new things for standard, strat, uncovered with yesterday's error, which was a very silly error, to be honest. We're going to go over that actually quickly, even though I'm going to be showcasing the first thing out of just a couple examples too. Fresh, like unmarked charts. Like I've been working on NZD because I'm going to be utilizing this in NZD, odd, euro, and pound. It's probably what I'm just good with currencies, to be fair. Anyway, new things for Standard Strat uncovered with yesterday's error. So it actually did set up right, but then you didn't get an entry because of the playable range, right? There was none, right? So it just doesn't make sense to enter. And that's one of the new refinements that I'm going to be probably implementing with the 4 AMD clarified V2 criteria, as I'm going to refer to it as. Anyway, so new things to Standard Strat uncovered with yesterday's error. When charts are unclean, go to whichever past period of time we are collecting data on and go over a couple of days. And also after then went over standard Oanda charts, also compare with CFD futures, top-down recent bar close analysis, and what sort of intent to trade is displayed throughout the time frames. We have to analyze top-down on these charts and compare that with Owanda's narrative to aid our decision on how we need to see the market set up to get involved with what sort of intent to trade exists at the region of prices the market sat at as of 07. So there we go. So what we're going to go over first, I like this bit, slow 5-bit. We'll do 4-hour ttfm. So we'll just go to a random piece on the chart. So this is like complete, we'll actually need to have the 3-minute available. So I don't think I've done February, so we'll just go to here and then we'll just start the mock charts, and we'll just I bet there'll be an example at least from up to here. So, and let's just see if we can get down to the 3-minute, because we need the 3-minute good. So basically it's just standard 4-hour TTFM, so T trades fractal model. But you're utilizing the 4-hour as your bias generation. You need to have a strong close, and then you need to then have your structural time frame, which is your 30-minute, and you must have this on-side like CISD, and then you basically assess where within that CISD leg that's led into 7 it would make more sense to be happy for you to get on board that move relative to the context of what sort of intent is likely to exist and quote-unquote plague that region of where the market's sat at as of 7, basically. And then after that, you wait for the market to set up appropriately, to get a nice bar close, and then what you're doing is you're looking for a 3-minute CISD, or if it's already CISD'd, assess the appropriate point to get involved at within that CISD leg. Or if it has CISD, then what you're doing is you're assessing, does it make sense to get involved off the bat, or do you want to see so I immediately see that there's a nice bar there. We can just zoom in on that. Yeah, I really like this lo-fi Okay, so we'll just go from there. So 23rd of Jan. Hopefully we can get down on the thingy time frame. And we're being picky too with these bar closes. We're not like it has to be like, for example, this. Like relative to what consecutive bar pushes in play, relative to TT Trade's bias generation protocol. It does make sense to continue, and to continue that consecutive bar push. But like that wick rejection at the highs of this consecutive bar push also does kind of indicate that, yeah, potentially what we could end up witnessing within the next bars is like wick rejection, exactly what was shown here. And then anyway, yeah. But like, so we're not like, because you've got a lot of points to like you're not going to be short of potential trades. Let's just say that. So you don't give a shit if it's like not clean. So like here, it's just not clean. It has to be clean. So like here, to be honest, it's not really that clean relative to the consecutive bar push. Yeah, it's not really that nice of a bar close, but like look at where you are in proportion to the previous consecutive bar push range, and then you're getting like bullish closes. So you would just want to stay out of that. Here, same thing. It's maybe as if it had a nicer wick rejection, is just really prominent and stood out here, then yeah, go for it. But like that isn't the case. So like something like this, exactly like this. Okay, so I think this is enough examples because I want to keep this kind of short. If there's a one here, then yeah, we'll do it. If there's one here, no. Actually, this could be a good example to show. This one would be a bit iffy because you'd be like basically betting on upside, right? But you possibly could still end up taking a win here. So, because I have seen things like this, but like where it ends up actually you end up taking a win. So basically what I was rambling on about there is just like my consecutive bar push analysis knowledge and like understanding of, like, for example, so basically, right, first of all, my understanding of like the sort of way that market participants like perceiving the sort of way that market participants interact with X underlying products, like region of where the marketplace is relative to the region of what consecutive are pushed in place. So like here you're at the overextended region, and then obviously you've got the region in general which is just like where neutrally and just the facts of where the market's at, like it's here. But these prices are like are perceived different because of like the region of like what consecutive bar pushes in play. Like these prices, like, and how many bars are being traded up to the upside, it kind of adds like a tone into how these prices are going to be perceived as. But then ultimately you're then seeing how market participants go ahead and interact with the market at this price region, but then factor that in with the context of where amongst what consecutive bar pushes in play is region, like that those prices are falling like to be set at, right? So it's like really deep, like, and this is just what I've found works for me, like, and I know that like some people, what works for them just doesn't work for others, and you just don't really have that gelled, locked in feeling. Where it's like non-distorted perspective type thing, you know you're going to be good with operating with that set of criteria. So anyway, as we've marked up all the 4 hours, now technically what we can do is just stay on the 30-minute, aka with structural time frame. So it's the same principle with the and I've never went through these days, so I don't really know what to expect. But anyway, you can see it. You've got aligned CISDs. You're on that you're on that religious with what you're like with your CISD, just as long as you've got like, this I would kind of half consider this is the whole leg, but like as long as you're bullish into the new day, or rather to say that it's like the same thing as the standard ttfm, but like as long as you're bullish leaning into your time period, you're good, right? Anyway, so as of 7, where would it make sense to get on board what intent is poised to show, like, and see the market set up appropriately, right? Like as of 7, right? And for me it would instantly be here. My eye kind of just draws to it with ease, to be honest, but like I kind of uncovered like a psychological, like a subconscious like understanding that, well, what I'm actually doing here when I'm analysing the market, like as of the key time period for the standard TTFM, I'm obviously doing it as of the new day and then as of 7. But with this 4 hour, 30-minute and 3-minute thing, you're just doing it as of 7, right? And so basically, I'm basically considering how traders have interacted with the market up to the point of where the market started as of 7 now, and factoring in what possible scenarios you could possibly see unfold. So here, like you are quite overextended, but like you have got this intent sat around plaguing this region, but like it's kind of an experience based thing of where I want to see the market set up appropriately, and it's also contingent upon the situation at hand. But anyway, then what you want to see is a nice bar close. So you get that here as of 10. So we're on the 17th of February. Right, 17th of February. We'll just do a couple of examples, and then basically, so it's set up appropriately as of 10. And then what you're doing is you're basically seeing whether CISD has led into the. See, this is just a first random day, right? But obviously you're coming at the charts as of 10. And what you're doing is you're marking like your external CISDs. So like here, this would be it. I'm not gonna like go through them all, but like, and again, even sometimes with the CISDs, it's like a bit, it's like a bit discretionary. Like like for example, like if you've got like for example, sometimes what you'll have is like, yeah, like here, right? So like I would personally stick with this as your CISD. But then you got this. This is like quite an impulsive move. I could possibly go with this. I'll try and find like a good example of what I mean of how like sometimes it's discretionary. Yeah. So obviously it's the last up close bar, right? So yeah, you don't think you get one here. Oh no, actually, yeah, you don't think you do. And then here, and then here, and then you lost. It would be down close case, it'd be last up close bar. So that would be here. But you see, I would probably still mark. I'd probably mark there, right? Because it just doesn't really look clean, right? But yeah, so because it's like it changes the state delivery to the last up close bar, and then anyway, so you're getting a push down here. So yeah, this is a prime example. So I would personally stick with this, and I wouldn't like be marking any of these. That's just not clean. But then, and even as of this, and then if you got a bar closed down here, if there's a weak bar, I'd probably still stick with this. But then it's like a really impulsive, and then it's like this, and then the last up close be there, and then here, and then there, and then you could possibly mark that. To be honest, actually, now that I look, but I would probably go with that. And then your last up close is here, and then here. So there we go. So this is kind of a clean example, but obviously in the next couple of examples, we'll probably end up getting a scenario where it isn't that clean. Because it kind of, yeah, so like this is a good example actually. So here you've got like this, you got this, so this you're bearish, and then you change here. So then, well, actually it doesn't even break below that low, and if it did, I probably would go with that, to be honest. But then you got this, bam, and then you got this, and then you change. I would still stick with that, to be honest. It's just not clean. So yeah, I definitely would. I just looked at it again, second take. But anyway, so what you're doing is then, as of 10 in this case, the point we dropped down has already been a CISD. So we assess would it have made sense on the CISD itself to get on board. In this case, yeah, and you would have had your stop here. But then what you're doing is, because it's already CISD as of 10, is we're assessing where as of 10, like with what sort of like market interaction has went on as of 10, and what like sort of way that region prices that the market has been sat at and traded like from the CISD point up to 10, and it's left like what sort of interest is like laying around that region where it would make sense to then like get involved at. Like here, you got wick rejection shown in this region, you wouldn't want to buy here because it could easily just retrace, right? So in this case, what you would want to do is you'd want to get in the appropriate point. So for me, it'd be at the open of this bar, and it's like, why the open of this bar? Well, just because that's where it makes most sense, like appropriate to do so, relative to like the scenario at hand. So it's completely based on experience. And anyway, see, it goes, and also one of the rules too with it is like, from the point, if it just soars straight away, so like this leg here, basically, you cut the idea. But as you can see, it does still. You wouldn't want to get involved in there, and plus it is also out of session. But you get the gist. You would want, if the market came down here, you'd buy here, and then I would place my stop about here. So what you also do when your stop loss placement is as of the CISD, regardless of whether it doesn't make sense or it does make sense to get on board as of the CISD, you're assessing where you would have your stop loss if you were to enter on the CISD itself, right? And then you're utilising that as a benchmark point to line up where the appropriate point stop loss could be, and then it possibly adjust it. But I would have it in relatively a similar place, and basically the trade would look something like this. So I would, yeah, I'd probably place it like that, and then I'd just go, and then it's a 1 to 1.5. So you risk 1% to make 1.5. And yes, for this I would probably use a 1% risk. But anyway, so that's that example. We'll do one more, and I'm pretty sure then you get the gist, right? And then because I need to then probably help my dad with something. So yeah, this is a really nice example. So basically, like with the bars that like I'm factoring in like on nice, it's like I'm utilizing like my experience with like what sort of interactions went on within that most recent time period and where that most recent time period is sat relative to the region of what consecutive offers in play. Like, is it a really overextended region with regard to where the market's sat and where traders have available to be like interact with the market at that region, you know, relative to the consecutive bar push play in play. And then you've got the region in general with where the market's sat at, which is just like, you know, you're just factoring in like how our traders trading the underlying product at where the market's sat at, like relative to the most recent bar close. But like you get way more context with like what consecutive bar push in place. So with how traders then interact with the market prices, what are available in general, but in the context of what consecutive bar push in play, which, you know, you're above the previous consecutive bar push high, you know, you kind of overextended, you got a nice bar push, and then you also have factor that in with the TT trades bias thing. And as you see, and yes, I do refer to them as TT trades. Just I've always done it, so just bear with, but like ignore it. I know it's T trades, but yeah, you get a wick above here, and then you close below with a very nice prominent wick rejection that's very distinctly identifiable, and it's just beautiful and fair. Then what you're doing is you're going to the 30-minute time frame, and you're seeing whether there's been a CISD. And also sometimes, so this is actually a really good example to showcase, sometimes there hasn't been a CISD into the open, and usually, or into the time period you're looking to trade. Now usually on these occasions it makes sense to get on board straight on, like on the CISD itself, right? So on here, you'd be waiting for the CISD, right? And then as of here, you'd be then waiting for the market to set up appropriately. But sometimes, even on the CISD itself, it makes sense to just get on board. Now, in this scenario, because it's NASDAQ, I would probably want to see a push above, to be honest. Or, to be honest as well, like maybe it's just a nice bar close from this open, so like a nice wick rejection. So actually, yeah, you would miss this. And anyway, it just sold straight off the open. So it sold straight, yeah, basically off the opening time period, right? So like, and I by accidentally came across this week too. Like I was just scrolling on Twitter, and I seen some guy enter some trading in the London session. I was like, what the hell is this guy doing? You know, like cause it was a pretty nice trade, yeah. So and then I scrolled to the 4, and I was like, oh shit, there's been a nice 4-hour close, you know. And what was I gonna say? And then I just went to the 30-minute, because on his chart it said the 4-hour 30-minute thing, but I couldn't really. It said the 30-minute, 2 minutes. He said the 30 minutes and 3 minute like model, right, on like the TT Trades indicator thing. And but like I couldn't find anything. But then anyway, relative to the 4-hour, it made sense. So yeah, I happened to come across this, and yeah. So anyway, here you wouldn't be doing shit because you don't have a CISD. So like here's another example where like you're not getting involved. But like in the next video I'll do one more example, but like I'll just showcase what you would want to have seen here. So you would have wanted to push above, and then like a nice close, and then nice close, and then if it was very nice, you could just look for you could just look for the entry model criteria on the 3 minute, and that would also have to make sense too. You wouldn't want to be getting in at that very highs unless it made sense to do so, and that's also contingent upon the scenario at hand. So I really do like this method because it's really robust, system, like criteria wise, and also relative to my experience, I can then factor that in and make it even more of a stronger edge. So maybe you can do that too, I'm not sure, but anyway. And then you would either want a setup like a nice bar, and then you would just want the 3 minute CISD and then get involved, right? So nothing crazy, but it is just relative to like you've got a bias time frame with regard to like how traders are willing to interact with X underlying product at the region it's set at, relative to a larger time period, which is therefore showing you like a larger region surrounding that recent bar close. And then you're looking for a structural time frame like alignment, and then 3 minute basically. So it's really good. Anyway, that's this first criteria, and we'll go over a couple more examples in the next video, and also what we're then going to showcase with the next thing.